Thank you, Jeff. So is Wall Street killing retail? With oil prices falling below $50 a barrel this year, one would think that retail names would benefit. But December retail numbers show that consumers aren't putting their money to work. Is Wall Street type management, do you think, to blame? Well, joining me now to break it all down, Burt, Flickinger, Strategic Research Group Managing Director, Brian Sozzi, Belus Capital Advisor, CEO, and Chief Equities Strategist. And there you both are. What do you make of this? I mean, it was a shock to see those December numbers, Brian. What happened?
Well, I think we all think because gas prices have fallen, let's say you're saving 10 to 20 bucks a week, everybody's shopping in every store, and it's not happening. And I think that's why I'm obsessed with those dead mall photos, but that's what is happening. Me too. Yeah. Consumers remain very choosy. They'll go to Best Buy, but they won't go to JCPenney and Macy's. One store, and they're out the door.
Well, here's one of the problems, though, Burt, because, you know, I'm so glad that Jeff had that report today because I've seen this. And I was in Arizona. I mean, malls are dying. What does this do to those retail names, those brick and mortar stores that are traditional mall names, whether it's a Sears or even Gaps are still pretty popular in malls?
The toughest thing, Cheryl, is with Home Depot not moving into big box spaces, Walmart not moving into big box. Big box is largely dead, and if a co-anchor goes or two co-anchor goes, the whole mall goes.
A co-anchor is like a Sears or a Macy's
yes.
or Bloomingdale's or something like that.
So while the mall stocks have not been affected yet, there's going to be a retail recession of big box as we get into the second half of 2015, into the second half of this decade. So the mall and shopping center owners may be the worst places to go. There's still selectively some retailers are good places to go, but overall retail's like Charles Dickens wrote in Tale of Two Cities. It's the worst of times and it's the best of times for some.
Well, do you think, Brian, what do you make of that assumption or that question?
Yeah, well,
do you think that Wall Street is ruining these retail companies? Wall Street doesn't, you know, that management type of style that works at a Wall Street bank doesn't work in retail.
Well, no, and you're going to see it, I think, come February with Sears. I mean, Kmart bought Sears in 2004 for $11 billion. The combined market cap of this company is $3.5 billion. You had Eddie Lampert there was trying to manage the business to finances. Come February, you'll probably see the announcement of 250 store closures, and that will trigger, I think, what Burt was saying, a lot more mall closures across the country. And I think these malls will ultimately be reclaimed by the community, data centers, and ultimately gyms.
I was surprised, Burt, by what happened at Macy's in the last month or so. You've got management changes, closings. Macy's was really the bellwether of how to successfully run a retail company, and now they're hurting.
Macy's will still win on click and collect, so Macy's.com with the Macy's four-wall stores. But to your prior points with Brian, is you look at JCPenney, which was on life support for 2 years when the Wall Street people came in. Bill Ackman at Pershing Square, Steve Roth at Vornado almost killed the company, and when they got rid of the Wall Street people, Penny stabilized and is on the right path now. If you look at when 70% of the department store sales volume went bankrupt between the late 80s and early 90s in this country, it was Bob Campo with Wall Street financing that rolled up all those department store companies, raised prices, cut staff, killed the sector, and retail's been reeling slowly since.
It's so interesting because when you talk about names like Bill Ackman, for instance, I mean, we're talking about activism. And these are activist investors. They did not build the company. They bought into the company via the shares, most likely. And the criticism of activist investors like Ackman, like Icahn, they don't know the business that they're going into. And that's a danger to a company.
Well, I think they're very much full of themselves in many respects. That if you get an Eddie Lampert to think they could go in there and buy a dying business, fix it up, and make things wonderful, it doesn't work. Even JCPenney, you know, they thought they were going to re-engineer the whole company. It just didn't work out because the business is so price competitive.
But there are activist investors who really understand the detail and the rhythm of retail. So you look at Jana Partners with Walgreens Boots, with Safeway Albertsons, with PetSmart. They're batting 1,000, but that's rare to have that happen on Wall Street. It's really what you and Brian references. Wall Street doesn't know what it's doing from the money side to the shopper side, and that's where Wall Street steers Main Street wrong on retail.
They used to call it silent partners. Real quick before I let you guys go, Brian, biggest trend for 2015?
Best Buy. I think a lot of these big box retailers are going to have to reinvent their sales floor. You'll see a lot more interesting shops, and I think Best Buy leads there.
Interesting. Okay, they're looking better, by the way. Go ahead.
Consumer motivated primarily on price, using mobile apps to drive down the prices online and four-wall as well.
Burt Flickinger and, of course, Brian Sozzi. Guys, thank you very much.
Thank you.
Good to see you both. We talked about JCPenney again.